The Latin American debt crisis, which unfolded in the early 1980s, was a major financial turmoil that affected several countries in the region. During the 1970s, many Latin American nations borrowed extensively from international banks to fuel development and economic growth. These loans were used to finance infrastructure projects, industrialization, and other development goals. However, by the early 1980s, a combination of factors led to a severe debt crisis. Rising global interest rates, plummeting commodity prices, and economic mismanagement created a perfect storm for these countries. The economic situation was exacerbated by high levels of external debt, which many nations struggled to manage as their economies faltered. The crisis began to unfold in 1982 when Mexico announced that it could no longer meet its debt obligations. This declaration triggered a chain reaction, leading to a series of defaults by other Latin American countries. As a result, the region faced a sharp economic downturn characterized by deep recessions, high inflation, and widespread economic instability. The crisis had profound social and economic impacts. Many countries experienced significant economic contractions, which led to increased poverty and social unrest. The economic difficulties also resulted in political instability, as governments struggled to manage the crisis and implement necessary reforms. In response to the crisis, international financial institutions, such as the International Monetary Fund, IMF, and the World Bank, intervened to provide emergency loans and support. These institutions imposed structural adjustment programs as a condition for their assistance. These programs required countries to implement austerity measures, economic reforms, and policy changes aimed at stabilizing their economies and restoring financial credibility. While these measures helped stabilize the economies in the short term, they often led to additional hardships for the people of Latin America.